So, imagine you're running a business in a jurisdiction where the corporate tax rate is this beautifully low, 10%.
Right, which sounds like an absolute financial paradise on paper.
Exactly, on paper. But there is a catch. To actually maintain that rate, the government requires direct real-time API access to your company's accounting software.
Oh, wow.
Yeah. And if your server goes down for like 24 hours, or if a minor data mismatch happens between your inventory system and your cross-border customs declarations, an algorithm automatically freezes your operating bank accounts.
With no human review at all.
Done. No human review, no warning. Your capital is just locked until you can hire a forensic auditor to prove your innocence. So I have to ask, are you operating in a tax haven or a tax hell?
I mean, it completely forces you to reevaluate what a tax burden actually is, doesn't it?
It really does.
Because you might be paying very little in actual currency to the state, but the operational friction, the constant threat of just total operational paralysis, the sheer cost of proving your compliance every single day kind of makes that 10% rate almost irrelevant.
Which brings us perfectly to the core mission of today's deep dive.
Mm.
We are looking at this fundamental rethinking of global taxation.
And it is a massive shift.
It really is. So our main source today is a really fascinating July 5th, 2026 article by David Klein. It was published in Metallurary.
Right.
And it covers this brand new, highly provocative white paper from the Geneva-based Taxhells Strategic Research Initiative.
Yeah, led by researcher Mia Galgao, right?
Exactly, Mia Galgao. And she argues that the old metric for evaluating a tax system, simply looking at the marginal tax rate, is basically dead.
Completely dead.
Yeah. The new burden isn't just the percentage of money the government takes from you. It is the amount of data, the operational bandwidth, and, frankly, the privacy that you are legally forced to surrender just to participate in the economy.
It is a profound structural shift. I mean, if you run a business or manage investments, or honestly, if you simply want to understand the architecture of the modern global economy, you have to recognize this pivot.
You really can't ignore it.
No, you can't. We are moving away from a system that measures wealth extraction and toward a system that essentially measures forced transparency.
Right. And to see just how radical this shift is, I think we need to look at the baseline we are shifting away from.
The old world.
Yeah, the old world. Klein's article references a 2001 study by Nico Hansen and Anke Kessler. And back in 2001, the definition of a tax hell was, well, it was incredibly straightforward.
It was just a place with high tax rates.
Exactly. And a tax haven was a place with low tax rates. The entire global competition between nations was based on, moving physical capital across borders just to find the lowest numerical rate.
Because Hansen and Kessler's framework perfectly described a world that was tied to physical territory and localized financial institutions.
Right.
Like, if you moved your money to a bank in Geneva or the Cayman Islands, the money physically or legally resided there, protected by the sovereign laws of that specific territory.
The state's reach basically stopped at its own borders.
Exactly.
It's kind of like the old highway toll booth system. In that 2001 model, you paid a toll, which is your tax, when you physically crossed a border or triggered a very specific, localized financial event.
You paid the toll, the gate went up, and you drove on.
Right, and your journey on the other side of the gate was entirely your own business.
Yeah.
But Galgao's white paper suggests the new system is, it's entirely different. It is no longer a localized toll booth.
No, not at all.
It's like the government has essentially mandated the installation of a GPS tracker inside your vehicle.
That's a great way to put it.
Right. It doesn't just charge you at the border anymore. It dynamically monitors where you drive, how fast you are going, who is sitting in the passenger seat with you, and it automatically deducts funds based on continuous real-time behavioral data.
And that is the exact mechanical shift Galgao is documenting in the paper. The battlefield for international competition is no longer physical territory.
It's data.
Yes, it is data sovereignty. And the catalyst for this wasn't some overnight change either. It was a slow, methodical rollout of what the paper actually calls an alphabet soup of transparency regulations.
Right, the acronyms.
Yeah, the acronyms. We are talking about the OECD's Common Reporting Standard, or CRS, the United States FTCA framework, and the European Union's DT7 directive.
I actually want to stop and look at the actual mechanisms of those regulations for a second.
Yeah.
Because it is really easy to hear acronyms like FEFIA or DT7 and just completely dismiss them as, standard bureaucratic red tape.
Oh, absolutely. People tune out.
They do. But the paper points out these are not just administrative tweaks. They fundamentally alter the social contract by forcing private companies to become, basically, extensions of the state's tax apparatus.
They deputize them.
Exactly.
Yeah.
So how exactly are these frameworks siphoning all this data?
Well, let's look at FATCA first, the Foreign Account Tax Compliance Act, which the U.S. rolled out. Historically, if a U.S. citizen had a bank account in Switzerland, the IRS had to formally request information from the Swiss government based on suspected evasion.
Which is a slow, human-driven process.
Incredibly slow. And it required probable cause, but FATCA bypassed the foreign government entirely.
Wait, how?
It essentially told every foreign financial institution on Earth you must automatically comb through your own databases, identify any U.S. citizens, and send their financial data directly to the IRS.
And if the foreign banks just said no?
If they refuse, the U.S. government imposes a crushing 30% withholding tax on any U.S.-sourced payments going to that bank.
Wow. So they weaponized access to the U.S. dollar to force foreign banks to become IRS agents.
Precisely. The bank assumes the cost of building the software, conducting the audits, and transferring the data, all under the threat of just total financial excommunication.
That's wild. The state completely outsources the cost and the labor of enforcement to the private sector.
Yeah, and DAC7 in Europe takes this a step further, specifically into the gig and creator economy.
Right, the platform economy.
DAC7 forces digital platforms. So think Amazon, Airbnb, or even freelance marketplaces to automatically collect and report the revenue, banking details, and tax identification of their sellers directly to EU tax authorities.
So it's automatic, continuous reporting.
Exactly. And the platform is legally liable if a seller's data is incorrect, which forces the platform to aggressively police its own users.
Meaning you really cannot participate in modern commerce without generating this massive, non-negotiable digital footprint that gets instantly shared across borders.
Which brings us right to the tipping point of Mia Galgao's research and the new definition of a tax hell.
Okay, let's hear it.
Because this data collection is mandatory and ubiquitous, the procedural and informational cost of following the rules is now frequently higher than the monetary cost of the tax itself.
Okay, I have to challenge that premise a little bit because it sounds like a massive exaggeration. Let's ground this in reality for a second. I might be paying, say, a 40% marginal tax rate. Nearly half my income goes to the state. Are you seriously arguing that a corporate SaaS subscription for tax reporting software and filling out a few digital forms costs more than handing over half of my liquid capital?
If it were just a software subscription, you would be entirely correct to push back. But the paper is measuring systemic operational drag, which goes far, far beyond the price of a software license.
Okay, paint me a picture.
Let's build out a concrete scenario. Let's take a mid-size enterprise, an SME that sells specialized manufacturing components across Europe and North America. Let's say they do about $15 million in annual revenue.
Okay, solid business.
Under the old system, their primary tax burden was their corporate income tax at the end of the year, plus standard VAT remittance.
Right. A heavy bill, sure, but a very predictable annualized event.
Now, overlay the modern compliance regime to satisfy CRS, DAC7, and cross-border anti-money laundering directives. This SME cannot just file an annual return anymore.
What do they have to do?
They have to implement automated control systems that verify the tax residency and the beneficial ownership of every single supplier they buy from and every vendor they sell to.
Every single one.
Every single one. If one of their European suppliers has a discrepancy in their UBO, their ultimate beneficial owner registry, our SME's automated system must flag it.
And if they don't flag it?
They assume the legal liability for their supplier's non-compliance.
Oh, wow. So they are on the hook for someone else's paperwork.
Exactly. So to mitigate that massive risk, this $15 million company now has to hire 2 full-time compliance officers. They have to retain a specialized cross-border tax law firm on a monthly retainer.
Just to keep up.
Yeah, and they must purchase enterprise-grade auditing software. That alone is hundreds of thousands of dollars in fixed overhead that generates absolutely zero revenue. But the real cost is frozen capital.
The algorithm freezing the bank account for my opening example.
That's exactly right. Let's say their inventory management software has a slight API desynchronization with the EU's automated VAT clearinghouse.
Just a tech glitch.
Just a glitch. The algorithm detects a mismatch between goods shipped and VAT reported in real time. Within milliseconds, it can trigger an automatic freeze on their European merchant accounts.
which means they can't operate.
Right. The SME now has $400,000 in working capital locked up. They cannot make payroll. They cannot pay their freight forwarders. They have to hire emergency forensic auditors at $800 an hour just to find the API glitch and petition the tax authority to release the funds.
And that process could take weeks.
Easily weeks.
Man, when you lay it out like that, the 40% corporate tax rate really is just the entry fee. The actual tax hell is the continuous daily threat of operational death by 1,000 algorithmic cuts.
That's the perfect way to phrase it.
The state demands total perfection in your data, and it punishes data errors with the exact same severity as actual intentional tax evasion.
And the white paper makes a really crucial point here regarding who actually bears this burden. Massive multinational corporations have economies of scale, right?
If they can afford it.
A Fortune 500 company can absorb a 50-person compliance department and millions in auditing software. It is a rounding error to them. But for the SMEs, who are the actual engines of most economies, this administrative burden is a structural barrier to entry.
It crushes their competitiveness before the tax rate even factors into the equation.
Absolutely.
This naturally leads to a really strategic question. If traditional high-tax countries are transforming into these high-surveillance compliance traps, what is happening to the escape hatches?
The havens.
Right. I think everyone knows the traditional role of places like the British Virgin Islands or the Cayman Islands. In the 2001 map we discussed earlier, those were the low-tax, low-question squares on the board.
You set up a shell company and disappear.
Exactly. A company could shield their assets behind a veil of corporate secrecy, operate largely out of view. So, are those jurisdictions immune to this whole data sweep?
They are not immune at all, and the article actually cites the British Virgin Islands as the prime example of this complete collapse in traditional secrecy. Yeah, the era of the anonymous offshore black box is completely over.
So how exactly did the high-tax nations force the offshore havens to capitulate? Because it obviously wasn't through military force, it had to be financial coercion.
It was a highly coordinated pressure campaign, primarily led by the OECD and the European Union. They essentially told jurisdictions like the BVI, you will dismantle your corporate secrecy, or we will financially isolate you from the entire global economy.
By weaponizing blacklists, right?
Exactly. If a jurisdiction refused to adopt automatic information exchange protocols, or if they refused to establish public registers of beneficial owners, the EU would just blacklist them.
Meaning any financial transaction flowing from, say, a European bank to a BVI entity would be subject to massive withholding taxes.
Or just outright blocked entirely. The BVI banks would lose their correspondent banking relationships in New York and London. They would be cut off from the SWIFT system.
Wow. So it is the FATCA mechanism applied at a sovereign level. Comply or literally starve.
Exactly. So the BVI, just to survive, had to adapt. They are now forcing entities incorporated there to disclose their ultimate beneficial owners. The corporate veil is being completely pierced.
The secrecy that defined their competitive advantage for half a century is just being systematically dismantled in the name of global transparency.
It really is.
Which completely destroys the binary model of havens versus hells, doesn't it? If the traditional havens can no longer offer secrecy and the traditional high-tech states are deploying total data surveillance, the entire global map is just a gradient of observation.
That is spot on. And Galgao's paper visualizes this perfectly. We can no longer categorize jurisdictions on a simple high-tax versus low-tax axis. We have to view them on continuum of surveillance.
Okay, unpack that continuum for us.
Sure. So on one extreme, you have the modern tax hell. As we discussed, the actual tax percentage might be a very moderate 20%.
But the surveillance is high.
Yes. Mandatory, real-time data transparency, aggressive cross-border automated controls, and zero tolerance for administrative errors. The state demands total visibility into every aspect of your operational life.
And on the other side of that continuum, if it's not a secret tax haven anymore, what is it?
On the other side, you have jurisdictions offering high levels of legal privacy, limited automated data harvesting, and wider operational autonomy for the individual or the corporation.
I think the shift from the word secrecy to privacy is really vital here, because those words are often used interchangeably in the media, but strategically and legally, they were entirely different concepts.
They are fundamentally different. Secrecy, in the context of the old tax havens, was about hiding assets to evade legal obligations.
It was a mechanism to break the law without getting caught.
Exactly. Privacy, on the other hand, is the fundamental legal right to control your own data and limit unwarranted state intrusion into your lawful affairs.
So the Swiss researchers behind the Taxhells Initiative are making a fascinating prediction about the future of global capital flow here.
They are.
They hypothesize that in the coming decade, states will not compete by offering zero tax evasion hubs because the OECD blacklists make that basically impossible.
Right.
Instead, forward-thinking jurisdictions will compete by offering premium legal privacy.
That is the new competitive pitch. Families, investors, and SMEs will actively seek out jurisdictions that minimize their data footprint.
Right. They will utilize tools like trusts, foundations, and family offices, not to hide illegal funds, but as legally compliant shields against overwhelming state surveillance.
Exactly. If jurisdiction A requires full API access to your life, and jurisdiction B only requires an annual, cryptographically secure summary of your taxable events, capital is going to flow to jurisdiction B.
Because capital seeks efficiency.
Always. And right now, aggressive data harvesting is the ultimate inefficiency.
The authors of the white paper actually use a deliberately aggressive phrase to describe the current state of affairs in these high surveillance jurisdictions. They call it a new fiscal inquisition.
It's a heavy term.
It really is. It evokes images of a relentless, uncompromising hunt for heresy. But in this case, the inquisitors aren't human tax inspectors knocking on your door with a briefcase. The inquisitors are algorithms.
It is a machine-driven inquisition. The algorithms are constantly cross-referencing your banking inflows with your VAT filings, your digital platform revenue, and your cross-border supply chain data.
And if the machine finds a discrepancy,
It assumes guilt and administers a penalty like freezing an account completely automatically. The burden of proof is entirely inverted. You are guilty until you spend the operational capital to prove your compliance.
I want to look at this impartially for a second, because when we use a term like inquisition, it sounds inherently malevolent. But governments aren't building these massive data nets just to torture small business owners for fun.
No, they aren't.
There is a legitimate, critical public interest driving this. Governments desperately need advanced digital tools to track illicit funds. We are talking about human trafficking rings, international drug cartels, state-sponsored terrorism, and massive corporate tax evasion that drains public resources.
Right. The stakes are very high.
And these digital tools make tracking those bad actors significantly faster and more efficient.
The article acknowledges that public interest, and it is a completely valid argument. The state has a duty to protect the integrity of its financial system.
What?
But the counter-debate raised by Galgo's research focuses on proportionality and collateral damage. The argument is that the state has cast a surveillance net so wide and woven it so densely just to catch a few malicious actors that it is asphyxiating the entire ocean of legitimate commerce.
It is the ultimate dragnet. To catch a money launderer moving millions, the state forces a local freelance graphic designer to upload their passport and biometric data to a digital gig platform just to earn $300.
While forcing the platform to report that $300 to 3 different tax authorities automatically.
Which brings us back to the structural shift in the relationship between the citizen and the state. Because the state demands continuous data to verify compliance, modern taxation is no longer just a system that measures your income.
No.
It is a system that measures your behavior.
And that is the realization that completely reframes everything we've discussed today. The tax system isn't just taking a slice of the pie anymore. It is actively watching you buy the ingredients.
Oh, that's a good analogy.
It is demanding proof of the supplier's corporate registry. It is monitoring the temperature of the oven in real time. And it forces you to maintain a digital log of every slice you serve, under threat of having your kitchen immediately padlocked by an algorithm.
It modifies behavior because the fear of triggering an algorithmic audit forces businesses to become hyper-conservative.
Exactly. You might choose not to expand into a new market, not because the tax rate there is too high, but because integrating their local transparency regulations into your software architecture is just too risky.
The compliance burden dictates your business strategy.
It becomes the tail that wags the dog.
We have covered an immense amount of ground today. We started by dismantling the 2001 map, where a taxhell was simply a high number on a ledger, and a haven was a secret island where you could hide your cash.
Right, the old paradigm.
We explored how FACET and DZ7 basically weaponized the global banking system turning private companies into mandatory informants for the state. We saw how this endless demand for data creates a compliance burden that literally eclipses the monetary cost of taxation, trapping SMEs in a daily battle to prove their innocence to automated systems.
It is a totally new reality.
It is. So the question you have to ask yourself isn't just what is my tax rate? The real question is, what is the structural, operational, and psychological cost of proving my compliance to the machine every single day?
And if we follow the trajectory of these mechanisms, it leaves us with a really critical question about the future.
How is this going?
Well, right now, these financial algorithms are designed to measure your past and present behavior to ensure perfect compliance. But algorithms thrive on pattern recognition.
Right.
As central bank digital currencies and real-time biometric reporting become more prevalent, how long until the financial system transitions from measuring your behavior to predicting it?
Oh, wow.
Could we reach a point of financial pre-crime where your ability to participate in the economy is restricted not because of an infraction you committed, but because an algorithm identifies a high probability that your business model might become non-compliant in the future?
An algorithmic freeze based on a forecasted error. That is the ultimate evolution of the fiscal inquisition. It is a brilliant, totally unsettling thought to end on. Thank you for joining us on this deep dive. Stay curious, question the mechanisms behind the acronyms, and as always, look closely at the invisible operational costs of the digital world around you.